it's going. So will you please give a warm welcome to Dr. Paul Traub.
Well, thank you. Thank you very much. See, he never met the man, and he already knows who I am, so that's a wonderful thing. Well, thank you so much. I appreciate the warm welcome. I got an opportunity to come here. Tim called me and asked me if I'd come down, and I said, well, there's no way you're going to get people on a Friday night to come and listen to an economist speak. So I give you credit for being here. Well, thanks a lot for coming down. You must be getting credits or something to be here, because I don't think you're probably not doing this because you want to. We're going to move quickly. I'm going to talk about the economy, but I'm going to try to talk about it in a broad brush sense. When I talk about data, especially to students, I like to point out that data can be done. I can take numbers and I can make them say anything I want. But what I try to do is talk to the data in real terms, in nominal terms, and in relative terms. And by that I try to point out that experiences, relative experiences that you are having today are far different from the experiences that I had as a youngster, and far different from the experience my parents have had as a youngster. And I think that's a part in economic data that's missed quite often when analyzing information is that animal spirits that's driven by that relational experience that people have when they're dealing with information. So coming out of this Great Recession, your experiences, I never experienced anything like that, but my mother experienced the Great Depression, and it impacted, it had a big impact on the way she did a lot of things and the way the house was run, the way the finances in the home were run, and I think that plays itself out over a period of time. So we're going to talk a bit about that. I'm going to move really quickly. I've got, believe it or not, 80 slides. And I'm going to move through 80 slides very rapidly. If we get to it, we don't get to them all, that's fine. But I have an hour, a little over an hour. When I looked at the agenda, it said an hour and a half. I build slides to that number. And so we're going to talk about the U.S. economy, and I always talk about C plus I plus G plus net exports. We'll talk about monetary policy. We'll talk a bit about the U.S. consumer, who's 70% of the U.S. economy. The housing market, and which really was the issue that put us into the Great Recession, quote unquote. Then we're going to dive into Michigan if we have time, and then we'll end up with Michigan's housing market, concentrating more on Southeastern Michigan and Detroit, because I don't know if anybody's familiar with Detroit. It's a small burb down near the river. And they've just come out of bankruptcy. So what's going on in that market is really important to Michigan. So goes Detroit, so goes Southeastern Michigan. Start with where the FOMC believes the economy is. And this particular slide is kind of an eyeful, but it basically talks towards the information that the FOMC had received since they last met, indicated the economic growth had slowed somewhat the first part of this year. Also, the labor market conditions were improving. And with strong gains, which were kind of surprisingly not so strong in the most recent labor market release. Unemployment rates diminishing, and what we'll talk about briefly, the underutilization of the labor force is actually starting to improve. Spending is increasing modestly, and been helped tremendously by falling energy prices. Business and fixed investment is advancing, but the housing market is still slow to recovery. And inflation in the terms of the Fed is still too low. And all indicators for expectations of inflation remain below the board's expectations or target of 2%. If you look at the overall economy, this chart here really lays it all out. And on my charts, if you see a gray bar, that's going to be recession band. The black line is real economic growth in billions of dollars. The red bars are percent change on a season-adjusted basis, quarter over quarter, SAR basis. So you look at where we are in this economic recovery. At first glance, it looks like we're well above the previous peak, and the economy looks to be well healed. We had 2.2% growth in the fourth quarter of last year after some pretty strong growth. Previous first quarter of 2014, we actually saw some negative growth from the winter, and now we're starting to see some of that data kind of play out again this year in the U.S. But overall, this looks to be fairly strong. But if I index each of the C plus I plus G indicators, and I say how the economy is doing based on particular components or sectors of the economy. So what we have here is we got consumption, we got investment piece as the green line, we've got government spending and net exports. Net exports is the blue line. You can see it's way down, and that's a wonderful thing. Oops, I pushed the wrong button. I'm pushing the wrong buttons, but that's okay. You guys will get over it. Page up. The green bar is, the blue bar is net exports. Being down is wonderful because net exports being negative, right? If it's lower negative means more economic growth. It's a more positive thing. It means we're exporting more. But you see the green bar, and that's what's going on the investment side of the house. When you look at it, everybody talks about this economy and how bad this was. Look at the overall economy, the black line. How if I index it to the fourth quarter of 07 to 100, it barely shows up. We look at the investment side, the consumption side barely shows up. So this is almost a one-stage recession. And it all kind of boils down to what happened on the investment side. So we look at personal consumption, you can see that it fell pretty radically on the piece that hurt the auto industry the most, and that's fixed investment on durable goods. Look at non-durable goods and services, very little movement in that. But the auto industry, which is durable goods, was hit pretty hard. And other durable goods, which were hit by the housing market, like refrigerators and stoves and things of that nature, they were hit very hard. And you can see how well it's bounced back. I always say when you look at this particular slide, you look at non-durables and services, they stay relatively flat because we continue to do a lot of those same things, right? We eat, we bathe, hopefully, brush your teeth, right? Those kinds of things that you would normally do. So you don't really delay those purchases. But in a time when you're fearful of losing your job, you postpone those things you can, and those are durable goods. And so that showed up heavily in the auto industry. So when you see how far it is down, and you see how far it bounced back, this is a great example of what happens, or that idea of pent-up demand. If I postpone something, so think of a line through here, kind of straight line through here, you get to this point, as being kind of normal, expected growth to get from point A to point B. And I pull that bolstering down, or that normal thing down. When I let go of it, I've created a lot of tension by pulling it down. I let go of it, it should bounce back relatively quickly and high, and we see this great bounce back, and that's where the durable good piece bounced back. So that's what's helping the auto industry. Vehicles are older, and durable goods wear out, no matter how durable they are, so we see that bounce back. We look at consumption and we break it down into retail sales. We've actually seen it fall in February and January, and part of that has to do, we are thinking, with weather. We see the auto industry saw a drop down, but it's 17.1 million sales in the auto industry. We are spending now, as a percentage of total retail sales on motor vehicles and parts, basically what we were in the U.S. prior to the recession. So that part of the puzzle has bounced back pretty radically, pretty dramatically. We look at real fixed investment, and there's your green line. This is residential piece. So you saw falling on overall investment, you saw falling on business investment, but that piece that's the residential investment side, that's the one that really took the hit. You can see how radically it's fallen. And you look at where it is now, it's still 14% below where it was at its previous peak. On the business side, we're seeing expansion, although we've seen some slowing in that expansion. The Isf Manufacturing Index, whenever it's above 50, means manufacturing is expanding. So we look at production, new orders, composite index, all above 50, although we've seen some tailing off so far beginning this year. We don't know if that's weather-related or if that's just a repositioning, but the positive takeaway would be it's above 50, means that there's still continued expansion. We look at the housing market, and we're starting to see some growth when you look at starts and you look at permits, but we saw, again, what happened in the early part of this year from all the snow and the severe winter weather, again, that we saw on the East Coast. Anybody here have family in the Boston area? Anybody try to get a hold of them because they're probably out in the snowdrift somewhere? They got 4 or 5 feet of snow. I mean, my sister-in-law lives in Quincy, just outside of Boston, and she lost her dog for like 3 days. You know, I can't find her. Went outside. Where'd the dog go? It's in the snowdrift. I mean, I talked to one auto dealer industry or heard anecdotal information about one auto dealer out in Boston area. Went 2 weeks without seeing a customer, right? And so how do you build homes if you can't find the ground where to dig the hole? And so we're starting to see that. But permits were up slightly, but this is well below where we were at the peak of the bubble, which we saw building permits in the 1.5 million to 2 million range on a pretty regular basis. And so when we look at what's going on internationally, the dollar continues to strengthen. Right? So now we're C plus I plus G. We're getting at net exports and what's happened to the dollar strength. But I always like to point out, when you look at the dollar, look how it rises during hard economic times. And part of that reason is we are the U.S. You knew who Mikey is. Remember the cereal commercials? A guy named Mikey who would eat anything, right? The U.S. is that economy where everybody wants to be. And in hard economic times, money floods to the U.S., right? And when you want to buy U.S. securities, you want to buy U.S. treasuries, you want to invest in the U.S. because you're concerned about what's going on in your local economies, you have to use U.S. dollars to do it. So that drives up the value of the dollar. So we're seeing this kind of smile effect every time you get to a hard economic time. So part of that rise has to do with we are the place to be because the rest of the world is slowing down. But also there's a correlation between interest rates and the exchange rate for the dollar. This is just a quick scatter plot of the trade-weighted dollar against the federal funds rate. And you can see as the federal funds rate is expected to rise, I'm guessing that part of the rise in the value of the dollar is the markets adjusting early on to what they believe the Fed is going to do by starting to raise interest rates. So they're buying dollars and securities early on. So that's impacting the value of the dollar now. And we're trading a lot more energy. We are producing more natural gas, I heard recently, in this country than anywhere in the world. And oil, we're producing tons and just barrels and barrels of oil. This chart here shows the ratio of oil imports to exports. So in 2006, we were importing 60 times the gas and oil that we were exporting. So 60 times more gas and oil was coming into this country than what was leaving this country. And so far this year, year to date, that number is down to 7.4. We're producing tremendous amounts of energy. And we're exporting 17 times the energy that we ever exported before. I mean, that's the big movement on energy price, of what's happened in energy. And of course, you add all that supply, what happens to price, right? Price starts to drop, and we're starting to see that show up in some of the economic numbers too. So we are exporting energy, and the stronger dollar, we're starting to see some fall off in exports and imports. But part of this has to do with a strike that was happening out on the West Coast. Not all of it, but part of it. There was a longshoreman strike. Things weren't coming in, things weren't leaving, so we think that's showing up a little bit in the numbers. But we're starting to see where the stronger dollar is starting to hurt exports a little bit because things are more expensive now. To buy American goods, it costs you more money in your exchange, right? If the exchange rate changes. Well, if you want to go to Europe, now's the time to do it, right? Because you got almost parity on the euro, and so it's a great time to travel overseas. But it's worse for us over here. And then the government piece. And I always take heat about this because I always talk about the government being you've probably heard the Fed talk about fiscal headwinds, right? Federal Reserve, we do monetary policy. We do not do fiscal policy. We just do monetary policy. We try to stimulate the economy through whatever means we can by adjusting interest rates, by making liquidity in the system, by creating robustness in the marketplace through using monetary policy. The fiscal side of the house is the government spending money. And as you know, the government has been contracting. And I'm not trying to say the government should be getting bigger. I'm never trying to say that. We were just saying that early on in this recovery, the government was contracting at a really bad time because we were trying. Normally, when you would see government expansion, when you try to do fiscal policy to help stimulate the economy, like the New Deal, or try to create investment, right? That you would create jobs and use that. But we've been continuing to see the federal government and really the state and local governments mostly contracting. When you break it down and you look at where it is from federal consumption, federal investment, state consumption, state investment, here's state investment. Down 15% from where it was when the recession started. Did anybody drive here today and notice the roads? Right? You have roads that haven't been, before the recession started, the roads were bad in Michigan, right? And now you go this long and the roads got only worse. And not only are they getting worse, but you're not investing in infrastructure. And so one of the big issues that we're seeing is now how are we going to pay for all this, right? We've got all this infrastructure stuff that's going to have to take place, right? And we're going to see a tax bill coming down the pike on, what is it, May 2nd or May 5th? We've got to read the vote on whether or not we want to raise our taxes. I mean, I really can't wait to see how that plays out. I'm really curious to see whether Michiganders, which I hate that term, the government uses so affectionately towards us. I'm from Michigan. I'm not a duck or a goose. But will we vote? Will we vote to raise our taxes? Right? And so it's going to be interesting to see how that plays out, because one of the biggest problems we're seeing is everybody recognizes we need this stuff, but nobody figures out how we're going to pay for it. Right? Can we just privatize it? Can we privatize the roads? Well, no, you can't, because it's against the Michigan Constitution. So you'd have to change the Constitution to have toll roads or privatize the roads. So it's going to be interesting to see how that plays out. But you can see even in investment on the U.S. side, you can see that that's down. But normal consumption is up slightly. So overall, blue chip forecast for this year continues to fall as we start. This happens every time, the blue chip. They start strong in January, and then as we get into the year, things start to tail off. You can see when the year started, we thought this year was going to grow by 3.2%, according to the blue chip. By February, they said it was 2.2, 2.9, no change. By March, they lowered it, and now in April, down to 2.9, and next year's only going to grow by 2.8%. So they keep lowering that expectation. And a lot of it came out of the first quarter. So you look at how bad the first quarter's hit. The low side of the consensus is 0.8%. The top side is 2.2%. In the first quarter, and the overall consensus right now for the first quarter is about 1.4. And a lot of that has to do, we think, with what's going on in the weather. So it starts to pick up on a fourth quarter over fourth quarter basis. So we still get 2.7% growth this year, fourth quarter over fourth quarter. But again, not the kind of growth that was originally thought early on in the year, somewhat slowing it down. And the world continues to slow down. If I was here last year and showed you this chart, this would be the bottom. And then next year would be higher. And then this would be the bottom the year before, and the next year would be higher. It's one thing you can always count on with economists. Next year will be better, right? It's like, if this year's bad, just wait. Next year will be better, right? And we keep saying that, but we keep continuing to see, especially in the markets, emerging markets, they keep lowering expectations of emerging markets. So overall economic growth in 2014, up slightly this year, 3.5%. Total economic growth worldwide. And we're looking to do 2.9, 2.8, 2.7. The U.S. is really the juggernaut. As much as we talk about China, we talk about India, we talk about these other economies which are growing really big. But I love the idea of a small percentage of a very large number, right? I'll give you 2% of $1 billion, or I'll give you 8% of $1 million. What would you rather have, right? So I kind of like the idea that we're still the biggest economy around, and we really drive. We still really, as much as people don't want to admit it, we still drive the world. And we look at what happens in some of these emerging countries, the ones that are tied most closely to energy, like Russia and Brazil, they're the ones that are being hurt the worst. At the same time last year, Russia was going to grow by 2.2%. In fact, that number was higher than that in March. I just adjusted the slide for year-over-year expectancy. But in March of last year, that was supposed to grow by 2.5% or so. But they're so closely tied to energy. As energy prices fall, they're getting hammered because they use that energy revenue so much to drive their economies. And now Russia's only going to grow by minus 3.9%, actually into recession. Couldn't happen to a greater guy with Putin, right? Because, if anybody needs to get some comeuppance, maybe he's the guy. But they're getting hurt, and that's hurting the world in general. So that's one of the reasons why you're seeing economic growth. So that first chart that I showed you, this is just basically the last data point. So normally, this far into a recovery, 28 quarters, you can do the math, divide that by 4, right? How many years we are since the recession started? 7 years since the recession started. And we normally would be up over almost 25% overall economy, and right now it's up just 8.7%. So that first chart that shows, boy, we're really well heeled, starts to take on a new look, right? When you start to see that, in 7 years we've grown less than about a percentage point per year, not even compounding, right? So you've grown about a percentage point per year for 7 years. And we look at consumption's up only 10%, usually up by almost 27%. Investment is usually up by 28%, up only 6.6. This piece, of course, exports is very strong because of energy, but imports strong because of the strong dollar. We can buy stuff, right? And we look at the government piece is actually negative. So the government is actually a negative contributor overall since the start of the recession to the overall economy. So that puts us back to where we should be versus where we are, and that's your potential. As I talked about pent-up demand, think of this red line, which is the Congressional Budget Office of projections. Notice how it kind of sags there, like something really heavy's been sitting on it for a long time. That growth rate in the midst of that is about 1% on an annualized basis. So even the Congressional Budget Office has taken potential down considerably for a short period of time as we work through this recession because of what's going on in the labor market. But this drop-off is what I called before about that pent-up demand. I pull down on that bowstring, right? And I create this pent-up demand. And then when I let go of it, normally one would expect it to bounce back. You don't go back to rest. The laws of physics. I create energy. I let go. I release that energy. Something's got to happen. And we are, 7 years after the start of the recession, still 2% below our already lowered potential in this economy. So that puts a different light on how well-heeled this overall economy is. I'm not saying that we aren't seeing some strides in certain places, but we are still struggling in this recovery, and that's why some of the board members still feel that there needs more impact by continuing to keep rates low, although we'll talk about that in a minute, how long that lasts. But anyhow, even with the blue chip forecast, we go all the way out to 2016, we're still not back to potential. With 2.8, 2.7 kind of growth fourth quarter over fourth quarter, 2.8, 2.9 kind of growth year over year, we still aren't back to potential with the Congressional Budget Office. So we are still kind of digging out of a hole. That's an oxymoron. You climb out of a hole, you dig into a hole. Right? So we're still climbing out of the hole. And that's kind of some of the perspective where the Fed's coming from, the reason why they've continued to hold interest rates so low. So we go into monetary policy, and as I mentioned earlier, we like to look at unemployment and inflation. The dual mandate of the Federal Reserve is to stimulate the economy, to create employment, and to manage interest rates. I used to say control inflation, but now it's more like manage inflation, right? Which we're trying to actually create inflation. In the eyes of the Fed, inflation is too low, 1.4%, and our target is 2%. People always argue, why do you want inflation? Because a little inflation's good, right? You want a little inflation. If I can buy tomorrow something cheaper than what I'm going to pay for it today, well, what am I going to do? I'll wait till tomorrow, right? If there's no inflation and I can get even 2% on my money and the price of something's going to go up 1%, I can wait till tomorrow. It's going to be cheaper for me in real terms, right? So some inflation is good because it helps stimulate overall economic growth. But we want some inflation, although we're not seeing it. And we look at what's going on in the unemployment rate, we're basically down near our target. 5.5% of the unemployment rate is very close to our target. We've seen job growth pretty steady, and we can see recovery. It was adding 89,000 jobs a year in 2010. That was up to 260,000 jobs a month, 260,000 jobs a month from 90,000 jobs a month by 2014. But we've seen a little slowness so far starting out this year. It actually fell so far year-to-date below 200,000 jobs per month. So a little bit of slowing down on the job growth side. But we are adding jobs, and we're seeing the unemployment rate fall. But we're seeing it as the participation rate fall. People are leaving the labor market. Participation rate of those people that can work and are willing to work and are actually looking for work, right? And you can see that number continues to fall. So I can lower the unemployment rate by not even adding jobs, just taking people out of the labor force, right? I can put you in prison, shoot you, I don't know. I can get rid of you, and now you're no longer in the labor force. You're now not part of the equation because you're out of the denominator and the unemployment rate is falling. So part of what's going on is we're feeling that the participation rate is probably a full percentage point or so, maybe even more if you look at some other analysis, probably 1.3 or so percent below where it should be, even more some analysts say. And part of that is normal. Part of the fall is normal, but to be that far down is not so normal. Because we look at the baby boomers now, those are the people born between 1946 and 1964. We are that big chunk of the population. Every baby boomer now is at least 50. If a baby boomer tells you he's 49, he's lying, right? Got to be at least 50 because he was born in the early side of the coin, was born in 46, right? So, and the end of it was born in 64, so you add the 50 to 64, you get 50, right? So that's where they are, and they become a bigger and bigger piece of this overall population between the ages of 65 and 80. So by the time you get out to 2025, it's going to be mostly all baby boomers, right? And we want to retire. We're starting to leave our jobs. So the part of that is that big cohort is leaving the workforce, right? And so you would see that falling out, and one would expect to see that impact the participation rate. We just think that it's falling more than it should have for a number of different reasons. And part of it is this blue piece of the pie. This is people that are working part-time for economic reasons. The people that are marginally discouraged have fallen out of the labor force. They got discouraged and they just quit looking. They've been unemployed for so long, they just figure, I'm not going to find a job. I'm just going to stay out of the labor force. Why go back to work? It's just too difficult. Or if I do go back, I'm only going to get a part-time job, so I might be better off just taking a reverse mortgage on my house. And just think about, again, the relational aspect that I talked about. If the recession started in the fourth quarter of 2007 and you were 55 years old, how old are you today? Right? If you haven't found a job and now you're 62 and you're looking at Social Security's right there, it's within my grasp. Right? Do I have to go back to work? Maybe not. It's been 7 years. Yeah, but I'm kind of enjoying myself. And I got Social Security now. I'll do a reverse mortgage. I'll go live with my son or my daughter, right? They'll move in with them. They'll take care of me. They're not going to let me starve, right? So you start to see that how the relational aspect starts to take place when you've seen this long, prolonged periods of something taking place, right? And so that's probably impacting. So when you look at this, what we call underutilization, and we look at this 11.1%, it's still about 1.1% above where we were coming into the recession. I mean, you're going to have a certain number of people that are moving around the labor force. You have to have some unemployment. Some unemployment's good. In fact, people willing to quit their jobs is actually good because that shows it's got a strong labor market. I'm willing to quit my job because I know I'm going to find a job somewhere else. And some people are desiring now to work part-time. They don't want to work full-time. In fact, I hear a lot of talk, especially about the younger generation, about people that don't want to do what their parents did. It's that old, not my dad's Oldsmobile, right? They don't want to be tied to a desk. They don't want to be tied to a job. They want to be flexible. They want to be able to move around. And they can do that now by working a couple part-time jobs rather than work one full-time job and be able to move around. But still, we think that number is probably about a percentage point or so above where it should be. So you take the participation rate, which is probably 1.5% or so below where we think it should be. Let's use 1%. And you take this and add another percent, right? So you got about 150 million people in the workforce, so 1.5 million. You take the other one that I talked about earlier with the total participation rate of the total population, you come up with about another 4 million people. So you got about 5 million people that are out of the labor force or not participating completely in overall economic development. You multiply that times 100,000 per person, and your economy's up by about $500 billion from where it should be if you were back, and you're right there back at potential. Right? And that's this kind of underutilization. How do we get that back? Because we got to get these people back to work. So how do you get them back to work? Well, one of the great things is to get an education. So I love the idea that you guys are here on a Friday night. Yeah, go get them. Because if you look at the unemployment rate for people that have at least a bachelor's degree, it's 3%. Right? Look at where it is coming into the recession, too. Still elevated slightly, but you're doing a lot better for yourself if you have a college education. And the participation rate of people with a college education is almost 75%. So you're doing the right thing, going to college. Right? You drop out of high school, less than a high school degree, your unemployment rate's almost 9%, and your participation rate is only 45%. That's why the unemployment rate is only 9%, because over half of them aren't even trying to look for a job. Right? You add that participation rate at the people that have educations, that unemployment rate for people with no college, high school education would be a lot higher than it is. They just gave up, quit working. So education's a wonderful thing. And you look at the participation rate for people between the ages of 16 and 24, and the unemployment rate right now, I'm saying it's tough. It's tough if you're younger, especially if you don't have an education, to go out there and find jobs. And that unemployment rate's over 12%, and the participation rate, again, about 50% of those people in that age bracket. So it's a wonderful thing. Now, one of the reasons why the participation rate is low is a lot of those people are not looking for work. They are in college. They are doing other things, right? But those that are looking for work are in the labor force, are having a hard time finding jobs, even though in that younger piece. So we look at overall job growth that I talked about before, and we're starting to add jobs, but where are we adding jobs? We're up 2.8 million from where we were at the start of the recession. But think about it, 7 years, right? With about 1.2 to 1.5 million new people coming into the population of people that can work labor. So let's do 1.2 times 7, right? You have that many more people going into the labor force. You got 8.4 million people that could be working, and you're only up 2.8 million in overall employment. It's a lot of people out there. I love it when they start the numbers box for me. You know, it starts to all come back to this kind of 5 million people, right, that are out there that aren't working, that could be working. But where are they working? Where are we finding jobs? We're down 1.4 million in manufacturing and 1.1 million. So 2.5 million are manufacturing and construction jobs that we've lost in this country and haven't come back. We're doing well in education and health services, leisure and hospitality. That's great, you know. You want fries with that, right? And we're hiring in those areas. But the problem with those jobs is they don't pay the kind of money that we used to get, right? This is 2013 dollars, which is pretty accurate even today. But average wage, about 50,000. And the areas that are red are those bars that are still below where they were at the start of the recession by significant amounts. And pretty much every one of those ones that are red paid extremely a lot more than where we've actually gained a lot of jobs, like in leisure and hospitality, or in other services, or in transportation and utilities, right? So that's what's making this mix. So you've got this weighted mix change of who's working for how much money, and one of the reasons why you're just not seeing wages go up, and you're not seeing incomes rising, right? But we're working more hours, right? Everybody's working. If this was a bunch of people that I a lot of times talk to when I talk to professional organizations, I always ask, anybody here working more than 40 hours? And they all kind of chuckle, right? We're working constantly, right? In fact, I had to shut my bell off on my phone so my wife didn't call me, or the office doesn't call me, right? We're connected constantly. We're always working, right? And so we're working a lot more than this indicator would say, but wages aren't going up. 2.1% growth rate in wages. Pretty much standard since 2010 as wages fell. And here's the bad news. That's nominal. That's not even adjusted for that 1.3% inflation. So in real terms, the wages are going up about 0.7%. So how do you draw people into the labor force if you're not paying wages, right? Or the jobs just aren't something they want to do. So I showed you those construction jobs and those manufacturing jobs and some of those other higher paying jobs. Those people are looking for work and they can't find work. They were making $100,000, $200,000 a year, or working on an assembly line making $75,000, $80,000 a year. Are they want to go work at McDonald's for $60 or $70 or $50 a week? No, they don't. They're not going to do that, right? So you can't get the people back into the labor force, and that's really part of the problem. Wages just aren't going up. And inflation, no matter how you look at it, is too low. You can look at CPI, you can look at PCE, you can look at core, you can look at total. I don't care how you look at it, they're all below 2%. In the mind of the Federal Reserve, inflation is too low. And even when you look at the producer price index, the most recent number is negative, right? So there's no even sign that inflation is going to go up because of all the indicators looking out through time, even by 2017, professional forecasters still don't have inflation back to 2% by 2017. And so then we can keep the interest rates low, right, which impacts the yield curve, right? You know, the spread of money, short-term, long-term money, right? I use a 1-year, 10-year Treasury. So as long as we can keep interest rates low on the short end, right, no matter what happens on the long end, we keep them as low as we are, you have a tremendous amount of liquidity in the system because you got all this difference between zero and that. There's your yield curve, right? Every time that yield curve has become inverted, this is the one thing you take away from me today if you invest in the stock market. Every time the yield curve becomes inverted, and even one of the professors I had dinner with said they look back to the 1980s, we have a recession. Never fails, never failed. It's one of the only predictive indicators that I can show you that actually would tell you something. 10-year, 10-year minus 1 year Treasury bill, if that becomes negative, button down the hatches within 14 months to a year, you're going to be in a recession, right? Sell, right? Sell. That's all we can say to you. Because here's your stock market tip for today. You buy low, sell high, and you make money. So this is your stock market tip. So the U.S. consumer, we saw some bounce in the incomes, 4%. But a lot of that has to do with profit sharing, benefit checks that have been paid out the first part of the year. If you look at post-recession, average growth about 1.7%, that includes that. Can anybody tell me what that is? 7% growth in real disposable income on a year-over-year basis? Anybody know what that is? They changed the capital gains law in 2012. So in 2013, they changed the percent on capital gains you were going to pay. Somebody ran to the stock market, sold all their stock, took their capital gains, lower their things, and you have a big jump in. And then the following year, completely reverses it out, right? Because you don't have that same capital gains thing on a year-over-year basis, right? But you look at this, 1.7% versus pre-recession. This is only back to 2000, about 3.1. Here's my relational story for you now. On average, through time, wages growing in real terms at 3.5%. If you understand the fixed rule of 7, if I have a fixed rate security growing at 7% per year, it's going to double in value every 10 years, right? So if I have real wages, after adjusted for inflation and paying my taxes and stuff, if I have real wages growing by 3.5% in 20 years, my real income doubles, right? That's a huge change in 20 years. So I get out of college when I'm 21 years old. By the time I'm 41, my income is double. I get out of college with a pretty good paying job, right? Because you saw some of those wage jobs up there for the people that have a college education. I get out of college making $70,000, $80,000, $70,000 a year. By the time I'm 41, I'm making 140. Those are in nominal terms or real terms. By the time you're that age, it'll be more. That's a big change. You go from being a used car buyer to a new car buyer. You go from renting an apartment to buying a house. It's a sea-level change in what's going on in people's lives. When you start to look at what's going on with 1.5 to less than 2% growth, you're doubling that period of time. So what it took me 20 years, it could take this generation 40 years, right? And the thing that my dad always talked about and we always talked about, you're standing on the shoulders of your predecessors, right? I'm standing on my dad's shoulders and my dad's standing on his shoulders because they were able to get that American dream and grow that real disposable income. This is a huge problem. This is where you talk about income inequality, you talk about what is a big headwind in economic growth. You're just not seeing wages grow, you're not seeing incomes grow, and the impact it can have on a whole generation of individuals is going to be interesting to see how it plays itself out. Now, maybe you'll make it up. Maybe we'll hit a period of time when wages are growing by 8, 9% per year for a short period of time. But you still have almost a decade of time here where you're seeing this kind of growth. And what would have happened in 10 years, right? If you would have had normal 3.5% growth, your income would be up by a half, 50% of what it was, and now it's not even up 25% or 10% of what it was over that same period of time. A big change in what's going on in incomes. And of course, when you make less money, you save more money. So saving rates have risen. And how does that impact consumption, right? I can't spend it if I'm saving it, right? So that has a headwind on overall consumption. But we've seen a very good windfall with falling energy prices. Gasoline and oil is falling. Gasoline prices have fallen. In fact, if I look at retail sales, gasoline stations as a percentage of retail sales, total retail sales percentage is down 3.7%. Since a peak in October 12, every American that drives a car a consistent amount of miles has received about a 3% or 3.5%, 3.7% raise in money now that they have. It doesn't have to go to the gas station to be used to buy something else or save, right? Or pay down debt, right? So that's a big bonus. On the flip side, it's creating problems on some of the jobs, especially on some of the jobs related to the oil industry and other areas, and you can see what it's doing around the world and how that's impacting exports for the U.S. So it's kind of a two-edged sword, right? You got more money to spend, right? but you're starting to see slowdowns around the world. And if you work for a company that made pipe for an oil rig, you may be laid off today because they're shutting down oil rigs all over, waiting for energy prices to spring back. And we're borrowing more money. This is the part that's really scary to me. This is consumer credit as a percentage of real disposable income, the highest it's ever been. Pre times when I was young, when my dad was young, when my mom was young. This is back to 1960. Anybody here alive in 1960? Yeah, probably three of us, right? This number is, I love this chart because it's just so beautiful. It oscillates around a mean, and it goes up when it should, and it falls when it should. I mean, it's just a lovely chart. And then interest rates fell. You can blame Greenspan. You can blame money coming into the U.S. seeking safe havens to invest in U.S. securities. Whatever you want to do, interest rates fell, cost of borrowing went down, people are borrowing more money. Right? I always like to tell the story about this. It's back when I was young. My dad had one credit card. It was a Sears and Roebuck's card. It was kept in a lockbox under the bed, guarded by Al Gore. You probably don't know who Al Gore is. Never came out. It would never come out because my dad wouldn't buy stuff on credit unless it was an emergency. Right? He just didn't use credit cards. Occasionally he would buy something nice for my mother, like a new washer, right, or a new dryer. People can get a chuckle out of that. But never put diamonds on a credit card. Are you kidding me? Who would do that? That's stupid, right? But to now we put everything on credit cards, right? We buy gum, put it on a credit card, right? And it's a wonderful thing as long as you can make the payments. But what happens when interest rates start to rise, right? Here's the federal funds rate against percent of disposable income going towards managing debt, and you can start to see what happens. As we start to rise rates, a larger and larger percentage of your disposable income is going to go towards servicing that debt, and all of a sudden there's your headwind. That's how it works, right? That's how we slow the economy down. That's how we prevent inflation, right? You have fixed amount of goods, you got lots of money chasing it, we take money away from you by charging you more interest, and you don't have as much money, right? You're servicing debt, or it costs you more to borrow, so you don't borrow. So it's a concern that the debt levels are as high as they are. Now those debt levels are just credit, they don't include student debt. Student debt's about $1.3 trillion right now. But I like to point out, especially when I'm talking to students, that I personally feel that that number is somewhat maligned. Because the money you're investing today is going to pay you dividends in ways that you will never understand. If you take that 1.3 trillion dollars, you look at it as debt for education, and you look at what's out there in auto debt, which is about $1 trillion. Does anybody here believe that when they buy a brand new car, it's going to be worth more when I pull it off the dealer's lot than it is the day I sign those papers? But you're going to get return on that dollar. In fact, I ran the numbers and I did some back-of-the-envelope calculations, and the return on investment for an education is better than buying a house, right? Now, people say, well, who would want to buy a house? But actually, trust me, someday, even though you don't think so, you'll want to buy a house, right? Because even if you don't make money on it, you got equity, right? Over time, if you buy a $100,000 house and then you live in it for 25 years and you pay it off, at the end of that time, even if it doesn't rise in value, what do you have? $100,000, right? And maybe it's depreciated, but at today's inflation rates, it won't depreciate that much. But still, you can start to see that it's an investment, and I think people want to do it. You're better off with that college education. So I don't look at that $1.3 trillion the same way. Granted, you have that service that debt, and that is an issue with no income growth. And that's where the problem starts to come full circle. No income growth, you got this service debt. How am I going to service the debt? I'm not getting wages, blah, blah, blah. You can start to see why it's such a large problem, or at least talked about so much, especially in the media and on the internet. And so we look at the consumers, the U.S. consumers, household net worth is up from the previous peak. After falling $12 trillion, $12.5 trillion from peak to trough in the recession, is now up another 14.7 trillion above the previous peak. You can do the math, right? You add 12 to 14, right? You get 26. You add the 5, you get $27.2 trillion change in net worth. So people are saying that we have to make up for that loss. That loss was made up for, right? $27 trillion move $14 trillion above where it was. We are the juggernauts. We are rich in this country. Not everybody, and there's the issue about the disparity and who has it, the haves, the have-nots. But that's why America is doing so well, is we've got all this wealth. Anybody have any concept of how much is $1 trillion? When I was in college, $1 million was a lot of money. And then when I started studying economics, I could talk about billions, and I'd walk around going, well, $10 billion here, $10 billion, right? Trillions of dollars now. Trillions of dollars. If I had $1 trillion in day one of the Mayan calendar, that means day one when this calendar started, and I spent $1 million a day until today, I would have over $200 billion left to spend at $1 million a day at 2014 years. Takes you about, well, I think it's 2,739 years to spend $1 trillion at $1 million a day. So unless you're like a baseball player or a basketball player, right, you could live pretty good, or a boxer. On $1 million a day, you could live pretty good, right? But, you know, that's how much $1 trillion. You're looking at 27-some trillion switch, up 14 trillion. That's a lot of money, right? And so that's a huge change. So the American household is doing better in that regard, and so that's why consumer sentiment's starting to improve. It's not so much the labor markets. It's not a lot of other things, and part of it is gasoline prices are down. They feel wealthier at the pump. But consumer attitudes are up to 93, pretty close to where they were pre-recession levels, not near the peak that they were when interest rates first were starting to rise, back in the Greenspan years when the stock market was going crazy and everybody was just giddy with you know, we actually spent our way through this recession, right? We didn't even know that recession was there. We just kind of spent our way through it. But we can see where we are now. We're starting to get back to those points in time. So the U.S. housing market, I've got a few minutes left. I'm going to run through this real fast because I got an hour and a half here, and I'm going to use it up. So we look at the housing market because this, if I look at this recession and I look at Professor Nash and I were talking prior to the meeting, and he made an interesting comment, which I kind of agree with. This is kind of, you think about this Great Recession and you compare it to the Great Depression or you compare it to other times, there may have been other recessions in the course since the Great Depression that were just as difficult. When you go back into the 70s or the 80s, or when you were fighting double-digit inflation back in the 70s, or back in the Volcker years when he was trying to stamp out inflation, when we had interest rates, prime rate at 20%, and you're borrowing at prime plus 2 to keep your business running. Those were difficult times to run a business, right? This recession kind of boils around what happened in the housing market and what happened overall in residential investment. Because if I look at this residential investment piece, if I look at normal, total private investment would be up 28%. We're up 6% now on average. If I look at the housing stock growth over the long period of time, you can see housing stock from 1965 grew in total about 1.5%, right? But look what's growing here. It's these houses that are vacant. Vacant part-time, vacant all year round. Dual home, people buying a second home, right? Big growth. If I collapse in on that in the most recent years, you can see that overall demographics show occupied home ownership only up about 0.8%, total up about 0.9%, but this continued growth here that seems to bubble up when we get to this point in time with these extra homes. Well, everybody understands what happens when supply and demand, right? If I have a lot of supply and I have a fixed demand, what happens to prices? Prices tend to fall, right? And homes were just available. People were building them. We were building homes. Even if we weren't going to use them, we were building them. You know who's going to have this problem? China. China's been investing in whole cities that aren't even occupied, right? That's the way they're driving their economy, right? Investment in infrastructure for homes and apartments and complexes that aren't even being used, right? So they're going to have all this excess capacity, and people can't even afford to get into it, right? But we have all these homes, right? And people couldn't afford to get into it. So we saw this big bubble in stock. Vacant houses bubbled way up, starting to come back, right? Because we stopped building them for a while, right? We're starting to fill some of those homes. In Detroit, we're just tearing them down. But other places, we're starting to really fill them. People are starting to move into them and starting to use them. So as this supply side starts to calm down, one would expect to see home prices start to fall. Why did the supply grow so much? And why did it become vacant? Well, one of the things that happened in the late 90s or in the mid-90s was the Homeowners Affordability Act was passed, but there were other things. And don't get me wrong, I'm a strong believer in the American dream. I mean, if you can afford a house, and you want a home, you should buy a home. But people were buying or getting mortgages that maybe not necessarily were able to own those homes. So you saw home ownership in the U.S. go to huge peaks. Everybody got a home, right? You made $40,000 a year, you qualified for $1 million mortgage, right? You had a pulse, got a mortgage, right? There was a period of time when if you had money, just a little bit, you could scratch together, you'd get a mortgage, get a house. It was an effort to drive up home ownership, but look what the ultimate goal was, right? We're right back we're actually below where we were when this whole thing started. We're no better off, except we've had the Great Recession, right? And people lost billions of dollars in home value, trillions of dollars. Home prices are rising, but they're rising on the new side faster than the used side. So new home prices, because that's starting to come back now. You're starting to see construction in new homes, and they're starting to see that show up. But here's the piece of that pie when I showed you net worth. This is the bottom part of it, right? This is the bottom part of that pie, of that chart. Here we are, down $2 trillion in homeowner equity from the peak after falling $7 trillion. It's up about 4.9 or whatever. Well, it's still down $2 trillion. If I add back in the kind of home ownership ratios and get us back to where we were, that number's still over $1 trillion below where it should have been in this peak. We created, and that's with a lot more people, right? So if this doesn't look like a bubble to you, then you should not be in business. Right? You should go and take up golf or something else. You should not be. That's a bubble, right? That's the whole issue, right? We saw all this wealth created. It shows up really, I think, in this chart probably as well as anywhere else. It's a confusing chart, and I apologize, but I love it because I need it, right? So it's a good chart. If you look at market value versus current cost basis, in other words, what does it cost me to build that house, right? And you got land, right? So if I go to build a house, what do I have to do? I have to buy a lot. So I got to buy this little piece of land, right? And then I start hammering nails and putting boards together, and I got myself a house. So it cost me so much to build that house, right? And I sell it to you. I'm not going to sell it to you for what it costs to build that house. I'm going to sell it to you for what it costs to build that house, plus this little piece of land, right? And then you buy that house. So you look at this kind of ratio here, and you can see what it was in 95, about 1.5, the ratio. So there was some equity, there was some value in the land. During the bubble, it jumped up. In other words, home prices got well beyond their replacement cost, right? And now, in a lot of areas, especially in Detroit, you pay less for the house than it cost you to build it, right? If you get into real estate, there's 3 rules to real estate: location, 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 right? So in certain areas, you can buy a home and it costs you more to build it. And that's what's going on in Detroit. A lot of these places are being bought up, being torn down, and just sit on the land and wait for the property values to start to revive. So you're starting to see this rise up a little bit. It's not getting back to where it was, and this is that piece of the pie that I talked about earlier. If we get that ratio back to where it was before, you get about another $1 trillion in homeowner equity, right? And you're still below that previous peak. So there's $1 trillion. $1 trillion doesn't seem like a lot to you or me, but $1 trillion is a lot of money, right? And so, that's that piece of pie. There's your bubble, and that's kind of where it's working out. You're starting to see this kind of correct itself, and I still think there's opportunities on the upside for the housing market because of this correction is going to continue to take place. We're starting to sell new and existing homes. You can see they sold a lot. Back in 2005, we were selling 7 million homes, new and existing together. Down in the bubble, that fell to about 3.5, 4 million total. We're just at 4.8, so we're only up about 800,000 homes from where we were at the bottom. And that's starting to tail off because supply is starting to dwindle, right? We're starting to run out of homes. People are in homes. We're not getting homes on the market as fast. And you can't get homes to sell. It's difficult to get the home, as I mentioned before, to appraise to what you have into it. A lot of people I talk to appraising groups, and I talk to home mortgage companies all the time. And one of the biggest problems is you go into a house, you get a buyer and a seller in the real estate market. You put the buyer and the seller together. The buyer offers a quote. The seller accepts it. They go to the bank to get a mortgage. They can't get a mortgage because they can't get the amount of the value of the home approved in the mortgage. It's coming in too low, right? And so there's really difficult times. So homes that they can sell, a lot of them more now are selling for cash. And back during the bubble time, they were selling for cash. as investors were buying up. Now they're selling for cash because people can get the home they want. They can pay a little bit more for it than they could otherwise finance, and then they go back and refinance the house for whatever they can get, take that cash out, and pay back whoever they borrowed the money from, their mother or their father. Maybe they have a whole bunch of money if they were in the stock market, because you saw what happened to the stock market, right? So that's starting to take place in the housing market. But still, very slow compared to where we were in the bubble, but still, we're starting to see activity. And again, the home median prices, new and used, I showed you that before. So the Michigan economy, real quick, and we're almost there. Can you believe it? We almost went through 80 slides. You guys are great. Anybody tired tonight? Want to take a breath? Take a breath? Okay. We'll keep moving. This economic index shows you Michigan economy, and when it's positive, shows above zero means we're growing faster than our long-term average. You can see the long-term average for Michigan has not been that stellar, but we can see that we're positive on manufacturing, construction, services, consumer spending. The overall index sums up to that. Michigan is actually now growing faster than its long-term average. We are growing pretty quickly. In fact, if I model these things in a nice little regression model and I calculate where I think overall economic growth for this in 2014 is going to come in at, we're not quite back to our previous peak, but we're up about 2.7% year over year compared to the nation as a whole, which is growing about 2.4%. So we're doing better in Michigan than the nation as a whole also, but albeit from a lot lower base, right? If I lower the denominator, if I lower the denominator enough, I don't have to raise the numerator that much, and I get a bigger boost, right? So that's one of the things that Michigan's experiencing. But we are growing, and growing in manufacturing because of the auto industry. Auto industry sales, remember that number, dipped way down to 10.4. We're selling close to 17 million now, but we're starting to see that taper off. Incomes in Michigan are growing. You can look at real, this is Michigan real personal income growth. You can see above where it was in 2000. However, real per capita income in Michigan, which was following the nation, actually led the nation back in the 50s and 60s, following the nation since the 70s, have taken a different turn here starting in 2000 when the auto industry first started to go into the problem. And the auto industries, I could talk a whole day. You have to have me back. I'll talk about the auto industry for a whole day. But they run into a whole lot of problems, building capacity they didn't need, and then all the transplants came in and started building cars. And you remember incentives, which was started by Lee Iacocca, buy a car, get a check. And then they started incentivizing vehicles just to keep the plants running, and it killed residual values. Residual values killed the auto industry, and it killed the auto industry, hit Michigan real hard, so you're seeing this sideways movement. In fact, Michigan, back in 1970, ranked 15th in the nation in per capita income, is down to 37th in the nation by 2010. We've clawed a little of that back, and now we're about 34th in the nation. Bottom is Mississippi, top is Connecticut. I didn't include Washington, D.C., but it'd be up there near the, it was always up near the top. But you can see big change in overall Michigan's well-being. So again, if I change the denominator enough, I don't have to work that hard to change the numerator. The other thing about Michigan that's really changing is you saw that chart on the U.S., and you saw stepping up, stepping up, stepping up until we got to this year, which I think is somewhat a seasonal anomaly, which will correct itself. But you see Michigan peaked in 2011, right? And that peak is back when the auto industry started to come back. We were bringing people back into the auto industry, and you kind of see that leveling off as we're starting to get more of a mature economy. So job growth in Michigan is starting to taper off. In fact, growing more slowly than the nation as a whole. So we look at overall breakdown in Michigan, you can see down 55,000 in government, trade and transportation. Look at manufacturing is down only 9.4. These are in thousands of jobs. So just down slightly from where we were at the peak. And so Michigan's kind of doing okay in that regard. And when you look at it compared to the nation as a whole, you can see that Michigan's actually, when you look at construction, you look at Michigan jobs, up 11% versus the nation as a whole, 18. But you look at manufacturing, up 15. There's construction. Manufacturing is here. Michigan's up. This is higher, lower. So we're only down 1.6% from where we were when the recession started in manufacturing. So we have just a little ways to go on the manufacturing side. We'll be back to where we were. Albeit, when the recession started, we'd already lost about 1 million jobs in Michigan. So you change in a denominator. But getting back to where we were at the start of the recession, Michigan's very close in manufacturing and even closer on the construction side, even closer on the business professionals and some of these other areas. So Michigan's coming back to where it was, prior to the recession. The problem is Michigan's recession started before the rest of the country, and Michigan started to fall behind before the rest of the country. So our denominator was already lowered before we started into this recession. So that's the untold story about overall Michigan's recovery. I'm not saying it's bad, it's just that part of the puzzle that we're dealing with in Michigan. And you can see the unemployment rate's now down to 5.9, and this is basically an index of labor force. What I like about this is Michigan labor force is constant, it's still growing. Michigan's a place now to come and get jobs, so we're starting to see that as a very positive thing for overall Michigan. Look at unemployment rates across Michigan. It's very different. If you go to, say, Grand Rapids with 3.9% unemployment rate, you go to Saginaw, 6%, Lansing, 4.6%, you go to Metro Detroit, 6.3%, Flint, 6.3%. So you look at Michigan as a whole, that 5.9. So it's different depending on where you are in Michigan. Again, location, 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 right? And you have better opportunities for jobs. And that's one of the things that led to what's going on in southeastern Michigan and the housing market, especially Detroit. Because you saw this, I could go, if I'm in Detroit, I got a very high unemployment rate. If I want to find a job, I'm going to go somewhere else. So people are leaving Wayne County, they're going to Oakland County, Macomb County, trying to find jobs. They have lower unemployment rates, they have better opportunities, and that's hurting the housing market in Michigan. If you look at Michigan compared to the U.S., overall housing prices were still down about 13%, 13.5% from where we were in 2005. I kicked that to the peak, where the nation as a whole is up 5%. We look at southeastern Michigan, and this is Southeastern Michigan Index that I created, and I compared it to the Case-Shiller. So I'm trying to show you here, these next indexes are ones that I created myself, but I'm trying to show you that they tie pretty close to the national expectation of the Case-Shiller. And so when I look at this, I kind of look at southeastern Michigan. I break it down into Oakland, southeastern Michigan, Wayne, Macomb counties. You can start to see home prices in Macomb County still down, but overall Oakland County is almost back to where they were at the peak. So Oakland County is doing quite well. Or actually 2005, yes. So that doing quite well. But you look at Detroit home prices. You can see Detroit home prices are still half of what they were in 2006 after falling some ways going into that. But Detroit's really getting hammered hard. But if you break Detroit out of Wayne County, you can start to see Wayne County is doing less. Detroit's not doing as well because Wayne County had such bigger prices, right? So I had a bigger denominator to work with. We look at home prices I went and pushed the wrong button again because I know you really want to see this. When I look at home prices in Wayne County, less Detroit, average 188,000, right? So I raise that denominator. It's harder to change an index because I got a bigger denominator. So that's why the index is wrong. But I look at Wayne County less Detroit, it's actually higher than Wayne County as a whole because the average home price in Detroit, across the board in Detroit, is about $35.6 thousand versus $73,000 that it was back in 2004. So I broke Detroit down into districts by zip code, right? So anybody familiar with Detroit, or you go to Detroit, you guys go to Detroit, there's the Woodward Corridor. That's what I created here. This is where it's all happening, right? It's the M1 rail. This is where all the investment is. You go all the way up to 8 Mile. It used to be the old fairgrounds. They have a building there. A lot of nice subdivisions. Really, that's the place where and you talk about the city, and you'll hear people talk about the city, it's a tale of two cities. You've got basically two cities going there. You've got the people that can't seem to get out of their own way, and they can't seem to make ahead, and then you've got all this investment, Dan Gilbert and Illich and other kinds of monies that are going into downtown area Detroit. And that's really changing this structure. So I broke it into southwest Detroit, west side, northeast Detroit, what I call East Riverfront. Because here's my thinking on this is prime real estate. This is real estate that's walking distance to Lake St. Clair. You're walking distance to the Detroit River. Who doesn't want to live on the river? I mean, that's kind of where the Fords lived and all the money lived back in the day, right? Down near the waterfront, right? You can walk to the river, you can watch the sunrise. I don't know, what do you do at a river? Fish. And so when I break that all down, I start to look at it by piece, you can start to see what's going on in the Woodward Corridor. Prices in the Woodward Corridor compared to 2006 are up almost 60%, 59% as of January. Look at that East Riverfront, they're up 14% from where they were. These are areas that are starting to get revitalized because that's where the money's going. But you go back to southwest Detroit where my dad grew up, and those homes are worth less than about 30% of what they were when this recession started. And those are the areas that have been hit really hard, and they're having a really hard time trying to turn those around. When you look at what's going on in Detroit, the new city, Detroit, and the investment for tearing down homes, the investment in lighting, the investment in infrastructure, it's going into these areas that are doing very well. Now, the mayor, who I've met with and talked with, the plans are they're going to do this across the city. But right now, it's that ripple effect, right? You throw the pebble in the water, and it ripples out. And right now, from that Woodward Corridor down that East Riverfront, and then it's supposed to going to drift over towards where the new bridge is going in, right? So they put a new bridge into Canada. That's Southwest Detroit. That's where it's going to land. Business opportunities if people come into the country from Canada, those kinds of things. So hopefully that all turns around. And you can see what's going on in home prices. So home prices on the Woodward Corridor in 2006. You could buy a home in the Woodward Corridor for $67,000. Average price now $113,000. So you would have bought a home down there in 2006. You'd be doing pretty good, almost double your money. You'll make about 40% on your money. And that's what's going on in that area. It's really turning around. Same thing with the East Riverfront side. Paid $70,000, it's worth $90,000 now. But again, the Detroit side itself is not doing as well. And you get down in here, if you can buy a home on average in Southwest Detroit for about $14,000. And you can't build a home for $14,000. So you know what happens. People can't afford to pay the taxes on a home, so they leave it. And you've got probably more than $14,000 in copper and brick and mortar and lumber. And so people go in and they start to disassemble those homes, and that's what's helping lead to the blight. Is these home prices are just so depressed that it's helping, not helping, but it's hurting the overall. Home sales in Detroit have tapered off recently. This is the bubble, right? When I was talking about investment in Detroit, people buying up homes at a loss. Now it's getting harder and harder to find a good home. Carl Levin recently retired from the Senate, U.S. Senate. He wanted to live in Detroit, and he said, I can't find a house that I want in Detroit. It's really hard to find a place where I want to be. Because where I want to be, it's just, there's no place for sale. It's really getting to be tough if you want to live near the business district, on that corridor of Woodward, or down near the riverfront somewhere in an area that's safe and where you want to be. So it's changing that around.